Good day, fellow investors. I received this email from Bloomberg how to invest $10,000 right now. So I really wanted to go through this because there is a lot to learn and follow from an investing perspective. And I think it will be a nice discussion here that arises from discussing what these four experts have to show us when it comes to investing. So Sarah Ketterer, Caseway Capital Management, she says that emerging market index did not do good over the last 10 years, so compared to the 4x of the S&P 500, but she says that while the past decade belonged to US stocks, emerging market should be poised to outperform. This is not a bad idea, and if we look at the emerging market ETF here, didn't do good over the last decade, so nothing much, 10,000 to what is it, 13,000 now. But if we look at the valuations, we can see that the dividend yield is 2.73%, still not much. And that is also something, yes, it looks better than the S&P 500, but it is not 5, 6, 7% like one could expect from emerging markets. The P ratio, keep in mind when they calculate an ETF P ratio, they don't calculate the losers in that calculation, just the profits. Therefore, these P ratios are always a little bit skewed. Yes, the price to book value is better, but then again, if we look at the holdings, these holdings might always be cheaper than counterparts. We have Taiwan, the risk there, Tencent, China, Samsung, Meituan could be a little bit more expensive. India, the most expensive Indian company, let's buy that. So everything that is expensive, now we have iron ore in the boom of the cycle. China Construction Bank, this lowers the P ratio. So developing finances based on market capitalization, okay, should do good. A lot of positions, what is this, 1,000 or something positions. So it is okay, you have a broad exposure to the market, and I think there is nothing wrong with this, especially if you invest over the long term. So you buy monthly, invest monthly, it should be good for wealth protection over time. Will it be better than the S&P 500? Keep in mind the S&P 500 has the best businesses in it compared to China Bank or something like that, which is not, let's say, the best business out there because owned by the government or something like that. So there is risk, there is definitely potential, but again, if you ask me, I'm biased towards stock picking, so I would pick the best buys at the right time here and not just a group, but okay, that is me. However, of the four ideas, this is not a bad one. What is a bad idea, in my opinion, is Ian here from Absolute Strategy Research saying how, and be very careful with the trick here. What is Ian selling here? Ian is selling fear. So the S&P 500 fell 20%, Nasdaq lost 20%, and then he says that equity valuations are not yet cheap, which means he is banking on the fear that it can fall another 20-30%. That hits people, fear, paralyzation. You see, your million can become 700,000. Stay defensive, that's an easy to sell thing. 4% 3 to 5 year treasury looks attractive. Okay, let's check the 4% treasury, and that is correct. If you invest now in the S&P 500, you get in the treasury 5 years, you get 4%. Yes. What is the inflation rate? Inflation rate is 6.5%. Which means that if you invest there, you still lose a few percentage points of purchasing power. Of course, it is expected that inflation will fall, which means that you get good protection. If inflation falls, do we go into a recession? Stock market can fall. So yes, there is a thesis, but let's say that average inflation with money printing and everything will be 5-6% over the next 5 years. We can have 2024 with 2%, 2025 with 10%. There goes your protection defensive down the drain. So this sounds good as an investment, but I see it still risky and providing no value. So that's just my opinion. Russ Kustarich from BlackRock Global Allocation Fund, he says not emerging markets, but go to Europe, increasing their allocation to European equities. Now, of course, underperformed by 30%, that has started to change, but let's look at those European equities. And of course, if we look at the yield, even better than emerging markets, 2.8%, the P ratio is still lower teens, so better than the S&P 500 of 20 something, and you might say, okay, very undervalued. But if you look at what we have there, then the top holdings are pretty much expensive. P ratios much higher. Of course, these companies now made the profits. Pharma, then we have financial, so very wide things here. But keep in mind, the P ratio doesn't show losers, so just the profits. And I don't think the P ratios are that low. This is 20 for sure. Let me just check. What is the P ratio of Unilever? 15. Okay, it's down. No, it isn't down. It was down significantly. Now it is even a little bit up in pounds, but still 3% dividend yield. Okay, I would go for emerging markets rather than a basket of European companies. But again, especially if you are focused on euros, and euros investment should not be that bad. So I would put this emerging market 1, Europe 2, bonds 55 positions if you must. Let's see the fourth idea here. Melissa, she's also going for international diversification, global diversification based on the expected weakness of the dollar going forward. Okay, these are Wall Street investment ideas, nothing wrong with it, but when it comes to investing, I also think nothing great with it. They will make their fees, even if some ETFs there have great fees. We discussed this one, emerging market. This is an amazing fee, no fee practically. So this is great compared to 4% entry fees in Italy or something like that. So very interesting, nothing wrong with it. Emerging markets, then Europe, bonds definitely not. But the key is to understand the risk and reward. If global economy goes into a recession, emerging markets will go even cheaper. They won't give you protection just because they didn't perform well over the last 10 years compared to the S&P 500. So if the P ratio now is 13, it will go to 7 if the S&P 500 goes from 25 to 12. That's a given. So no protection there. Then you have to see, okay, the dividends received, the quality, but from wealth accumulation, index funds, ETF investing, low fee, set and forget it, dollar cost average over time, both the European and the emerging market fund, but also the S&P 500 will do great, good. 5 to 10% long-term returns should be achievable, which is then again great for 98% of the population. Yes, I know, Sven. But see how it fits you. I personally am not for these, okay, you look smart, you say something, you have a thesis, and then whatever happens, you don't care because you'll have a different thesis. So just wanted to discuss this, how Wall Street sees the world, what they say. It was interesting clicking on this email. Hope you enjoyed it. See you in the next video.